Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. We're a few days away from the 2024 U.S. elections, but this week, we got a few important updates on the economy. And so while we've been talking a lot about the election and we're all anxiously waiting for election day to come and go, we're going to sort of refocus a little bit on these results and kind of some signals, if you will, on where things might be headed. So let's start with the third quarter. This is the first estimate of third quarter GDP, and basically it came out at a level of 2.8% annualized growth, and it's called the advanced reading. But essentially, this was just modestly below expectations. I've seen numbers from about 2.9% to a little over 3%, I think, in terms of different forecasts and consensus expectations. So just think of it as being really positive, but coming out at a level that's just a little bit below what people were expecting. Now, when you dig into the report, I think the punchline is that the consumer remains really engaged. So consumer spending was really strong, government spending was really strong. And so, you can kind of think of it as essentially the consumer continuing at 2/3 of the economy, essentially continuing to contribute to that positive growth. That leads us to that continued monitoring that we've been talking about for quite a while, actually, as it relates to looking for reasons to think that the consumer activity may slow down. So one important area for that, of course, is the job market. And so essentially this week, there are three jobs-related reports. I'm going to talk about two of them only because the last one's going to come out actually a little later this morning. And so the two we know about are the JOLTS report. Let's start there. So that really ended up being a lot weaker than the expectations. So think of it as the level of job openings falling to 7.44 million. So that it fell 418,000 against an expectation level of almost 8 million, 7.99 million. So that is significantly more weakness, if you will, in terms of that drop than people were anticipating. And actually that measure is now at a 3.5-year low. And also, by the way, the last report was revised down a little bit as well. So on the surface, you look and say, okay, so we're seeing a softening job market. That's sort of what the Fed's been architecting, right, was still higher interest rates. But interestingly, when we look at what's called the ADP Employment report, there was actually a little bit more strength than expected. And this is basically ADP using their service to be able to monitor private businesses in a anonymous way. And anyway, the bottom line is that the metric that was expected in terms of jobs added via that source was 115,000, but the actual measure was 233,000. And so a little bit firmer than expected. And then finally, just to mention it, it's the non-farm payrolls report that will come out after this recording. And that is expected to weaken. So I believe the consensus is for things to fall significantly in terms of new jobs by that measure. In any event, one other data point that we get regularly that we got recently is the Consumer Confidence Index. So it's done by the Conference Board. And basically, a little bit coincident with that sort of firmness of consumer activity, they actually have two indices. One is called the Present Situation Index. So think of it as people who are responding to this to basically be focused on the present. And that rose. 138 was the measure for what that's worth in October. A positive move for sure. And then the Expectation Index, which is really a focus on the future, which has been pretty muted. It rose a little bit as well, up to 89.1. Now, the level of 80, if it gets down to 80, that's basically a signal of a possible recession. And so you can think of it as moving away from that. So we all know things have been better than expected. The economy's been more robust than expected. And so these moves are not surprising at all. But I will say, which we talk a lot about, it's easy to look at these moment-to-moment, day-to-day changes and try to make something of it. We also think it's really important to look at perspective over time. And the punchline is these measures remain very well below what were really much more positive levels before the pandemic. So it's been interesting to see the consumer is sort of stressed in a certain way, but spending continues. And that's in the end, a bit of something to be focused on, because again, with 2/3 of the economy, the consumer plays a really significant role, and so keeping an eye on them and on us in a way is really, really important. Now, one sort of other takeaway from all this is with this strong economy, and what I would say is the cooling jobs market, which is what the Fed has wanted. The fact that those two things in a way are coexisting gives them just a little more room to not move too quickly, right? So if they keep rates elevated and we start to see signs of a recession, then they're going to feel pressured or lower rates. But when the economy's strong and kind of handling the higher level of rates, then keeping those higher rates on, at least to, almost like improve the possibility of not having a resurgence of inflation, that's going to be in focus for the Fed. And so, of course, we talk about that in a large part. We know that the economy and earnings are going to be related on the stock market, but also, it all comes down to really, where we head in terms of the economy and when we will eventually have a recession. The question really is when and how deep. So anyway, I know it's a little off topic relative to the election. We anxiously await the results, and we'll be talking a lot about those after the election. In fact, Brian Gardner, Stifel's chief Washington policy strategist, and I will be having another discussion on Thursday. And so just know a couple days after the election, we'll come back on and have a good conversation. You can go to stifelinsights.com to see the link to that session. Otherwise, I really appreciate you spending the time today, and we'll look forward to the next episode post-election. Thank you.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.